In 1995, Mr. Marks has been responsible for ensuring the firm's adherence to its core investment philosophy, communicating closely with clients concerning products and strategies, and contributing his experience to big-picture decisions relating to investments and corporate direction. From 1985 to 1995, Mr. Marks led teams at the TCW Group that were responsible for investments in distressed debt, high-yield bond, and convertible securities. He was also Chief Investment Officer for domestic fixed income at TWC. Previously, Mr. Marks was with Citicorp Investment Management for 16 years. Mr. Marks holds a Bachelor of Science degree, cum laude, from Wharton School of Business at the University of Pennsylvania, with a major in finance and an MBA in accounting and marketing from the Booth School of Business at the University of Chicago, where he receives the George Hay Brown Prize. Mr. Marks is a trustee and chairman of the Investment Committee at the Metropolitan Museum of Art, chairman of the Investment Committee and Board of Trustees of the Royal Drawing School, and an emeritus trustee of the University of Pennsylvania, where from 2000 to 2010 he chaired the Investment Board. Today's discussion will be led by John Culbertson, President and Chief Investment Officer of Context Capital Partners. Please welcome Mr. Howard Marks and John Culbertson to the stage.
Howard, thank you for being here. Welcome to Miami.
Thank you, John. Pleasure to be here.
Welcome to Context Summits. You've had a profound influence on our industry, and I appreciate you taking the time to communicate your lessons over 50 years of investing. I'd like to start with your background. You have a very traditional educational training for finance, Wharton undergrad, Chicago graduate school. But take us through the early years. What led you into finance? And then what led you to start Oaktree?
Well, my dad was an accountant, and when I went to high school, I took a course in accounting. And it's embarrassing to say it, but I loved it. And so I went to Wharton for my undergraduate. I thought I'd be an accountant and major in accounting, but then I started taking courses in finance and found that more interesting. So I switched over. When I got out of University of Chicago with a master's, I really didn't know what I wanted to do other than that it would be in finance. So I applied for 6 jobs in 6 different fields. And I ended up going back to Citibank in the investment research department because I had had a good summer job there the year before. And like they say, that's history. So, I did that for 10 years, became the bank's director of research for equities. That worked out quite poorly. Because the bank was what was called the Nifty 50 investor. And if you put your money in the 50 best companies in America in 1968 when I started, within 10 years you lost almost all your money. And so the boss put in, we got a new boss, and he put in a new director of research, and he said to me, what do you want to do next? And I said, I'll do anything except spend the rest of my life choosing between Merck and Lilly.
That's great.
And fortunately, he said, well, I'd like you to start a convertible bond fund. And then that summer, I got a call asking me to see if they said there's some guy named Milken or something in California, and can you figure out what high-yield bonds are?
Wow.
And so that was 1978, and that was the beginning of high-yield bonds. And, it's great to get in at the beginning, and markets were quite inefficient in those days. Nowadays we pull out our phone to check any fact. I always say there's no such thing as not knowing something. But 40 years ago, there was a lot we didn't know. And the few of us who ventured into what is now called alternative investing had the world to ourselves. Yeah. So that's really great. The origin.
That's great. So how did you decide to start Oaktree?
My co-founders and I were working together at TCW, as Kevin described. And, first of all, when we went there, we were not investing in funds with carry. And then we developed in 1988, I think, the mainstream world's first distressed debt fund, and now we are getting carry, and they wanted half the carry. And, if you're good and you can reliably turn $2 into $3, there's no reason to part with half the carry. So You know, and the other reason was that, you know, there was a big tent kind of place with many managers running many strategies in many ways. And I was uncomfortable fronting for strategies I didn't believe in. So we wanted to have a firm that ran our way, and we left as a group, and that's what we started at Oaktree.
Rest is history.
Rest is history.
I want to talk about your memos for a minute.
Yes.
Been writing for 30 years?
Yes.
Warren Buffett has famously said when he sees your memos show up in his inbox, he makes it a priority to read them because he always gains something from them. And honestly, on a personal level, I was trained as a derivatives trader, never trained as an investor. And in the mid-'90s, late 90s, one of my mentors said, you only need to read one letter if you want to learn how to be an investor. So it's been 25 years, and you're part of my education as well. Thank you.
Very kind.
Thank you. Why did you start, and how have you kept at it for 30 years?
You know, the latter question is the more interesting. I started in 1990 because I saw two related events that I thought the juxtaposition of the two was very interesting. And I'm not going to belabor it. Anybody who wants to can read it. All the memos that we're going to talk about are on the Oaktree website, and they're all free. And you can sign up for a subscription if you like. So. But the point is, there was an interesting occurrence that I just thought I'd write about. I didn't have a business plan. I don't think I thought it would produce any clients. And we only sent them to the clients. You know, this was the days of paper and stamps.
They were hard to get in the 90s.
Yes, that's right. But the interesting thing is that what kept me doing it, because in the first 10 years, literally, not exaggerating, John, literally, I never had a response.
Never.
Not only did nobody ever say they were any good, nobody ever said they got it. And so what kept me going is an interesting question. But I think the answer is that I enjoy the writing part. It's my creative outlet. And, you know, I had some things I wanted to share. But then on the first day of 2000, I put out a memo called Bubble.com talking about the flaws in the tech stocks. And that had two virtues. Number one, it was right, and number two, it was right fast. Because in our business, if you write slow, then they don't associate you with the outcome. But it was well timed. Yeah. And so the way I say is, after 10 years, I became an overnight success.
That's great. So I'd like to talk about your recent book, Mastering the Market Cycle.
Yes.
Getting the odds on your side, which I think the subtitle really tells a lot about the book. The book is fantastic. I actually like it most because it reads more of history and human behavior than it does finance. Right. Not a lot of formulas, not a lot of graphs. It's just it's very intuitive, very accessible. It's very well done. To start the conversation with the book, I want to read a couple of excerpts from prior memos I think will frame the concept of a cycle pretty well. So I'm going to read a couple of paragraphs and then ask you some questions. So in February of 2007, you wrote Race to the Bottom, famous memo. And in that, you were referring to the behavior of some mortgage lenders. And you wrote this: logical reasons and sober decision-making might be involved here, but so might competition to put out money and the usual late-stage belief that this time is different. Lenders and investors invariably depart from time-honored disciplines when cycles move to extremes, out of a belief that current conditions are different from those that have prevailed in the past, when those disciplines were appropriate. And just as invariably, they've shown that cycles repeat and nothing really changes. It was a few months later, not many months later, at the bottom, really the worst of the crisis, you wrote Limits to Negativism of 2008. And you wrote this: skepticism and pessimism aren't synonymous. Skepticism calls for pessimism when optimism is excessive, but it also calls for optimism when pessimism is excessive. In the third stage of a bear market, on the other hand, everyone agrees things can only get worse. The risk in that, in terms of opportunity cost or foregone profits, is equally clear. There's no doubt in my mind that the bear market reached the third stage last week. That doesn't mean it can't decline further or that the bull market's about to start, but it does mean negatives are on the table, optimism is lacking, and the greater long-term risk is probably not investing. You were not only right again, but you're right pretty quickly. Howard, why do cycles exist? We all know it. We feel it. We've been through them. Why do they exist?
Well, it's a great question. And when I got about two-thirds way through the writing the book, I started to ask myself that. Because I'm a believer in cycles. I accept the existence of cycles. I accept the importance of cycles. And I accept that cycles will go on forever. So, but after a while, I said, but why do we have cycles? For example, the stock market returns about 10% a year. Well, why does it just return 10% every year? And the interesting thing about the stock market is not only does it not return 10% every year, but it rarely returns between 8 and 12. Usually it's up a lot or quite poor. And so I came to the conclusion that the reason we have cycles is that most things have a positive underlying secular trend. And in the case of the S&P, it's 10%, 9 to 10%. But as humans, we're biased toward optimism. And I think the great reason can be found in what Charlie Munger, Warren Buffett's partner, always says. He quotes Demosthenes, the philosopher, who said, "For that which a man wishes, that he will believe." We call it wishful thinking. But the point is, everybody wants to get rich, and they tend to succumb to things that they think will make them rich. So while we have the normal secular trend in the S&P of 9 to 10%, every once in a while people get more excited. And they start to upvalue the future, and stocks rise 10, 12, 14, 16, 18, 20%. And psychology takes over from fundamentals. Fundamentals don't change very much. They grow a few percent a year, and they never go up 30% in 1 year. What goes up is prices because of a revaluation due to positive psychology. So I would call, if the fundamentals chug along and go up 6, 7, 8% a year, then I would call, well, most people would call a year in which it goes up 20% a year of above average appreciation. I would call it an excess, a year of excess. And eventually, when the excesses compound and the optimism takes the price too high relative to the fundamentals, then you're riding for a fall, and then you'll get a correction. So, it's easy to think of cycles as ups and downs, but I think it's more helpful to think of cycles as excesses and correction.
This is not about intelligence, getting this right, is it? It seems very simple. It's deceptively really difficult.
Right. Well, I have a friend in London named Richard Oldfield, and he wrote a book about investing entitled "Simple but Not Easy," and I think that's what we have. But you talked about the importance of psychology and the fact that intelligence is not enough. If you think about it, everybody has the same information. And I would say that the SEC takes it as one of its prime jobs to make sure that nobody has information others don't have. Everybody has the same information. Everybody is numerate. Everybody is computer literate. Everybody is intelligent. Everybody in our business. And everybody's highly motivated to make money. So if you think about that, it's unlikely that data and its manipulation is going to hold the secret to above average performance. I think it's emotional control. I'll use a shorthand term. I'll just say psychological assessment of what others are doing, understanding excesses and corrections. Those two passages that you read from the memos of 07, 08 were not about the economy or companies or profits. They were about psychological excesses, that in early 07 people were too optimistic and not risk-averse enough, and so not doing hard analysis. And then in late 08, they were too pessimistic, too terrified, too risk-averse, and consequently unwilling to invest regardless of how cheap things got.
What did you see that led you to go back and write that memo, The Limits of Negativism?
Well, as I recall, and of course it's almost 11 years ago now, but I had a meeting with a pension fund head, and I was trying to raise money for a levered loan fund that we had that was in danger of getting a margin call and melting down. So we had to get more capital into that fund to protect it from a margin call. So I went to and we did it once, and we reduced the leverage, and it still wasn't enough because loan prices were cascading down. They had never been below 96. Our fund was safe unless loan prices got to 88, and they did. So we raised more capital, reduced the leverage. Now it's safe down to 65, and it starts to approach 65, the prices. So I went back to my clients, and I said, we need more money, and the levered return on this fund is 22. So if you don't put up money here, it's like giving up some of your position. Mm-hmm. And she said, you want me to go through the whole thing?
I do. It's a great story. I love the story.
So she says to me, well, but what if there are defaults? And I said, well, we've been in high-yield bonds for, at that point, 30 years, and our average default rate has only been 1% a year. So if the return is 22, and you lose 1% a year to defaults, now you make 21, you have a great outcome. She says, well, what if it's worse than that? I said, well, the universe average default rate has been 4, so 22 less 4 is still 18. She says, well, what if it's worse than that? I said, the worst 5 years in history averaged 7.5. 12 less 7.5, 14.5, great outcome. She says, what if it's worse than that? I said, well, the worst year in history was 13. And by the way, when you have a default, you don't lose all your money. Let's say you lose 3/4. So 22 minus 3/4 of 13 is still 12. It's a terrific outcome. And by the way, in order to make 12% a year for the next 5 years, you have to have 13% a year defaults every year, and it's only happened once in history. And she says, well, what if it's worse than that? And I said to her, do you have any equities in your portfolio? And she said, yes, we do. I said, well, you better run out and sell them. Because if the world that you're walking me toward, everything crashes, equities are valueless. So the point is, it struck me what was going on. And you read that passage. And the point is this. I think that one of the most important jobs of the investor is to not swallow whole the story you're told. Everybody tells these stories because they want to attract capital to whatever it is they're hawking that day. And as that passage said, our job is to be a skeptic. And when there's too much optimism, when somebody comes in your office and says, I've been managing money for 30 years, and I've made 10% a year, and I've never had a down month, your job is to say, that's too good to be true, Mr. Madoff. Everybody, after the fact, everybody knew that they should have said too good to be true. But of course, they applied wishful thinking. Yeah. But what I realized from that meeting is that when there's too much pessimism, the job of the skeptic is to say, that's too bad to be true. Right. The point of that meeting was there was nothing I could say which would satisfy her pessimism, and where we could reach a point where she would say, you know what, it's not going to get that bad. And if it's not going to get that bad, then today's the day to buy. Yeah. So that was the conclusion I reached. And if you think about it, see, most people operate under the misapprehension that changes in fundamentals cause changes in prices. Mm-hmm. But that's not true. That's not true. It's changes in fundamentals filtered through changes in psychology that produce changes in prices. Fundamentals kind of go like this. You think about the economy, a good year is up 4, a bad year is down 2. So the economy kind of goes like this. Mm-hmm. Companies are levered, so their profits kind of go like this, and stock prices go like this. Why do stock prices fluctuate so much more than fundamentals? Psychology. And, in one of my memos, I wrote that and we saw this in the fourth quarter of last year, that in the real world, things fluctuate between pretty good and not so hot. But in the market, people go from flawless to hopeless. Mm-hmm. And when people think that the future is hopeless, meaning that asset prices incorporate zero optimism, then clearly prices are not too high and all the surprises are likely to be on the upside. So that's
great.
That was the genesis.
Thank you for telling this story. So it seems to me that most of our investing time is spent in the middle of a cycle. And then there's a lot of really interesting things happen on the inflection points. Right?
Yeah.
So I know you don't forecast.
Right.
I actually believe it's really, really hard, if not impossible, to make money at forecasting. But are there things you look for that are catalysts, that are leading indicators for what might show ahead of time what these inflection points might look like?
You know, when I was working on the book, I sat down and went over some of the conclusions with my son, who runs our family money. And I said, you know, when I look back, I really think that my major calls have been correct. And he says, yeah, Dad, that's because you did it 5 times in 50 years. And that's really the key. At the extremes, and the extremes tend to come along on average about once a decade. At the extremes, the logic is compelling and the probability of being right is high. And in between, not so. So if you're content with making one call a decade, you can do something dramatic and make a lot of money. Now, the thing is, you can't make a career out of making a decision once a decade. So people try to do it in between. But in between, by definition, the logic is not compelling, and the probability of being right is maybe a coin toss at best. And, you know, thinking about your question, the way you phrased it, I have a friend out in Los Angeles, Rick Kane, who started a firm called Kane Anderson. Some of you may have been clients. And Rick says that 96% of financial history took place within 2 standard deviations, and everything interesting took place outside of 2 standard deviations. And that's right, but not very often. And so the point is, we have to be patient in between. And we have to content ourselves with fundamentally driven value investing, and not, you know, I said in my first book that when there's nothing clever to do, the mistake lies in trying to be clever.
It's good. Yeah, it's really good. So, since the great financial crisis, the central banks around the world have been very willing to do some unorthodox things. Negative interest rates, buying credit assets, buying equities. Do you think the fact that central banks may be more willing to do even more unorthodox things changes the length or depth of cycles?
Well, I don't have to think about it. It has. The evidence is there. We're now in the second half of the 10th year of the longest of a 10-year recovery, and we've never had a recovery beyond 10 years. So I think there's a very high probability that this will become the longest recovery in history. And we're, by many measures, in the longest bull market in history. And people who invested in the S&P at the bottom in March of 2009 have quadrupled their money. So, I mean, clearly, some unusual things have happened. And I think that the central banks have a tough job. On the one hand, they have to regulate inflation by not being too aggressive. And then they have to support job growth by not being too negative. And they have to balance these two things which are in opposition. Unfortunately, some people think it's also their job to keep the markets going up. Some Fed occupants appear to have had that goal. Some White House occupants seem to think that's the Fed's job. But, in general, I would say that the longer a recession is forestalled, the more likely it becomes, and maybe the worse it becomes. Now, the interesting thing about this recovery, it is that in addition to being perhaps the longest in history, it's also the slowest since World War II. And I believe that the excesses I talked about, certainly until the tax bill was passed in December of 17, and some participants went in experienced a sugar high. But until then, we didn't have excesses. So what that meant was that there was no necessity of a very strong recession. We'll have a recession one day. At the present time, I don't think it's going to be a terrible one. But you know, if the Fed and the administration keep stimulating, you know,
could be.
The Republicans unanimously concluded that the last tax cut was a good thing, and they were the ones who were supposed to stand for fiscal moderation. So if the Republicans and the Democrats compete to cut taxes, to deliver their largesse, then I think we can get in trouble.
Builds up excesses.
Yeah.
Okay. I'd like to transition into the current investing environment. And in 2014, you wrote a memo called Getting Lucky. And in that, you talked about market efficiencies and the proliferation of data and processing power and what that has implied for certain types of strategies. My question, though, is because of this fact, do you think it's harder or easier to tell where we are in a cycle? Social media, sentiment indicators, does it matter?
You know, on the one hand, knowledge should be cumulative. We should get smarter over time. We should learn the lessons of the past. But on the other hand, I believe that things like wishful thinking and greed will always outweigh prudence and respect for history. So, and then we do have a piece of evidence, which is that the global financial crisis was the worst crisis in 80 years, and it happened recently when everybody should have been smarter.
Yeah.
So that belies your theory.
It does.
On the other hand, before I get off the topic, I want to say for the benefit of the audience that if you came into this business, let's say as much as 25 years ago, what have you seen? You've seen two bubbles, the tech bubble and the mortgage bubble, and two crashes. So there's a temptation to think that bubbles and crashes are the norm, and I don't think they are. They're excessive excesses, and I think we can have bull markets and bear markets and gains and losses and so forth. So, you know, at the present time, I don't think that the pieces are in place. I don't think we're in a bubble, and I don't think the pieces are in place for a crash.
Yeah, that's great. So there's been a lot of press has talked a lot about the mismatch of some types of securities, ETFs in particular, mutual funds in some instances, the liquidity of those structures and the liquidity of the underlying securities.
Yes.
How big a concern is that for you?
It's not a concern for me because I don't expect liquidity. You know, you should not invest in fundamentally illiquid securities with the expectation of liquidity. And you shouldn't, in my opinion, you shouldn't invest in vehicles that invest in illiquid securities and expect liquidity. You know, I mean, people say, you know, we know that high-yield bonds are illiquid, so I'd rather buy the high-yield ETF because it's liquid. Now, how can the vehicle be more liquid than the underlying? So my concern is for the people who are investing in perhaps ETFs is the right thing to talk about, in the expectation of liquidity.
Right.
And I wrote a memo about liquidity, you probably read it, about 4 years ago. Yeah. And I said because then people were starting to talk about that since the banks could not position like they used to, that liquidity was declining. And I wrote that the best defense against illiquidity is to not need liquidity.
Yep.
You know? And first of all, most trading is wrong. My son gave me a great quote at the time. Again, we were working on that memo. And he said to me, Dad, if you look at the chart of a stock that's been up for 25 years, and you say, man, I wish I had that stock, think of all the days you would have had to talk yourself out of selling. You know? I mean, who holds a stock for 25 years? Who holds it from $1 to 1,000? That's how the big money's made. Yeah. But instead, people sell. Why do people sell? Either it goes down and they're afraid they're going to lose more, or it goes up and they're afraid that if they hold on, the prices will evaporate and they'll kick themselves. Yeah. So the point is, the best thing is to latch on to some very good long-term assets and hold on to them. That's the most important thing. Now, can you do better by adjusting your portfolio at the excessives once a decade? I think you can. Yeah. But that's not the most important thing. The most important thing is to be a long-time holder of quality assets. And so if that's true, then liquidity isn't that important. And most people are ill-served by being provided liquidity. A lot of the funds we run, are 10-year funds. Yeah. And we do people a favor by denying them liquidity because we make it impossible for them to get out at the bottom. I'll tell you an interesting story. So in 1988, we started a fund that would invest for Japanese institutions in high-yield bonds. And 11 large Japanese institutions invested with us. And in the summer, August of 90, high-yield bonds had their first crisis. And they all called us up, and they said, we want our money back. And the price was about 80 cents on the dollar, which for a bond is a big fluctuation. So we said, unfortunately, you can't withdraw because the fund is closed-end for 2 years. They said, okay. So then a few months later, the crisis was over. The bonds rebounded to par. The 2 years were up. We called them up. We said, now you can get your money back. It's at par. They said, no, it's okay. We don't want it. They only wanted to get out at 80. Once it was back to par, they didn't want to get out. And that's human nature. It's human nature. So the point is that, the story about Hercules, and by giving up your liquidity with the part of your capital where you can live without liquidity, right. You're like tying yourself to the mast, yeah. Which is what Hercules did to get past the sirens. Yeah. And I recommend it.
Well said. Why do you think traditional value managers have struggled for so long? What is it?
They've struggled, well...
Relatively speaking.
They've struggled because value investors invest in value here and now, and earnings here and now, and visible earnings in the intermediate future. Whereas growth stock investors or prosperity-oriented investors invest in on the basis of dreams of future value and dreams of future earnings. Clearly, in optimistic, prosperous times, the latter will do better. And we've had, we're 2 years short of 10 months. So the point is, this has been a time when, to betray my value orientation, I would say this is a time when speculative assets have done better. Mm-hmm. Even in the credit areas where we invest, the more credit risk you took, the more money you made.
Better you did.
Now, that can't be the formula all the time. It would be too easy. And the answer is that the people who invest in the speculative or prosperity-oriented investments get crushed in the bad times. Right. But, since March of 2009, we've had some bad months. We've had 1 or 2 bad quarters, but we haven't really had any bad times.
So nothing out of the ordinary in particular?
No, and I think it's a normal rotation.
Yeah. Yeah. Okay. That's great. Howard, I want to read a short quote from Getting Lucky, which is a great memo, by the way. You wrote this.
I want to point out that when he says Getting Lucky, it's not in the campus sense.
I just read it as I see it.
Yeah. Okay.
I know how lucky I've been. I find it incredibly uplifting and the source of great optimism regarding the future to know and appreciate my good fortune, rather than detract from my satisfaction over the success I've enjoyed, because having to admit that it wasn't all my own doing, this realization makes me feel fortunate to have been born when and where I was, and to have benefited from the developments that came along. I revel in my good luck.
Yeah.
I like that quote. Our industry could use a little more expression of this kind of gratitude, Howard.
Well, look, none of us, to paraphrase Obama, None of us did it alone. And if anybody out there in the audience thinks that it was all your diligence and hard work, just ask yourself where your IQ comes from. None of us deserve our IQ. None of us did anything to earn our IQ. But, people who have an IQ are enormously successful, lucky. And my parents and my education and the jobs I got and the call I got asking me if I was interested in high-yield bonds, and the fact that this turned out to be the greatest time in history to be an alternative investor, it's been incredibly lucky. And I think that it's great to be lucky, and it means nothing if you don't appreciate your good luck. And the philosopher Cicero said that the thankful heart is not only the greatest of all the virtues, but it is the parent of all the other virtues. Mm-hmm. You can't be virtuous unless you're appreciative of your good luck. And once you are, it allows you to be charitable, generous, be a good mentor and a good parent, and a good citizen, and all those things. So, I think I've been incredibly lucky. And I thank my stars.
It's great. It's great. Howard, you've had an amazing career. You've compounded capital at 19%, I think is the number, net of fees.
In distressed debt.
Yes, in distressed debt.
And without leverage.
And without leverage. Extraordinary track record. But I think the reality is you've also returned tens of billions of excess capital to your investors, which is extraordinary. What's next? What's next for Howard Marks?
I hope more of the same.
Good.
There's nothing I'd rather be doing. And, most of the record was compiled by my partner, Bruce Karsh, who is a brilliant investor and who has run the distressed debt investments for the last 30 years, day to day. And, we have a great partnership and a lot of other terrific colleagues. So, I moved from California. I moved to California in 1980 from New York, and then I moved back to New York 6 months ago in 2013 because my kids went to college in New York, in the East, and went to New York to start their lives. And when I did, I gave up all my day-to-day responsibilities. I'm not throwing the switches anymore. And so all I have to do now is read, think, write, and speak. And it's a dream job.
Sounds like a great job.
Yeah.
Thank you. We have a few minutes for questions from the audience.
Great.
I'm going to ask, if you have a question, please stand and the mics will find you. There are mic runners around. Any questions?
Yeah, I think there's one here.
Howard, I saw you've have two now permanent capital vehicles, so you're in the daily markets with OCSL and OCSI. How do you feel about that strategy and that shift in Oaktree's strategy, and where do you think that'll go? And
well, if 10-year funds are better than one-day funds, then permanent capital goes even further in terms of letting us do the right thing for the clients. Plus, of course, it's wonderful for a manager to have money that they can count on. We were really happy to acquire the management contracts on those two BDCs. And the interesting thing about them is that if you know them, you know that they were remedial cases. They were not well run. And we thought, that the secular return over time on BDCs can be good, but the opportunity to take one from undermanaged to well managed, we thought was a very attractive opportunity. So we're very happy with that. We'd like to do more, and we're kind of bargain hunters, bottom fishers. Sometimes they call us vultures, and if you think about the economic environment for the last 10 years, there hasn't been much for us to do. We think we'll have opportunities in more remedial credit investments in the coming years.
Next question.
Here's one.
We'll get a mic.
Hi, Alejandro Caminos with Draper Global. My question is as machine learning and data science starts to play a bigger role, algorithms in the market, how much of that do you think is going to wear away on the psychology aspect, which I completely agree with you in that regard, the psychological...
Wear away?
The psychological factors in the market performance.
Okay. Well, I can answer almost every question by starting off, I wrote a memo. And in June, I wrote a memo entitled Investing Without People. And it talked about indexation and passive, algorithmic and systematic, AI and machine learning. And, you know, roughly 3/8 of the U.S. equity mutual fund capital is now run passively. And I think it's true at the bottom line that the trend did not take place because passive returns are so good. It took place because active returns were so bad. And I think that the word I use for computerized investing, except for, I mean, there are exceptional cases like Renaissance, which make inordinate profits consistently because they have a better mousetrap. But the term I would use for most automated investing is competent. And what do I mean? I mean, what can a computer do? It can incorporate a lot of data. It can do it fast. It can do it without error. And the last thing you said, it can do it free from emotional excesses. So I believe that computerized investing can produce results that are quite competent. They can probably do better than 90% or 95% of investors. I hope that they can't do as well as all investors. And it seems to me that they won't be able to, because I don't think, as I said in the memo, I don't think that a computer will be able to sit down with an executive and figure out if he's Steve Jobs. And I don't think that a computer will be able to read 5 business plans from Silicon Valley and know which one is Amazon. So I think there will still be room left for exceptional insight. That's what it all comes down to. We talked about the fact that it's not the data, it's not the data manipulation, it's exceptional insight that a small percentage of people have. And I hope there will always be room for that.
That's great. We have time for one more question. Right
here it comes.
It's Inna Zhuranskaya from Crediral. Mr. Marks, if you're to give an advice to a new manager who are kind of at the same stage of their career as you were when you started Oaktree, what kind of advice would you give? What this manager should do and what this manager should avoid?
My first advice is to start in 1968. And the people who start in 2019 are not going to face the opportunities that we faced over the last 50 years, period. Because of a lot of the things reflected in the questions already. But still, long-term investment, you have to, in order to be a superior investor, you have to understand things better than everybody else. So, a high degree of specialization, a high degree of focus, a high degree of intensity, long-term investment, high degree of patience. You have to be able to live through the bad times and the good times. Not trying to be clever and jump around too much. I don't like the idea of trading for a living. It seems antithetical to me. Emotions under control, very important. Don't, you know, everybody gets excited and buys at the top and depressed and sells at the bottom. Don't do it. Don't be one of those. And since the investors of the future are not going to make money like the investors of the past did, or the investment managers, I might say, then you should do it because you love it. But it's a great thing because it's always different. In his book, Fooled by Randomness, Nassim Nicholas Taleb talks about dentists. If you fill a tooth the same way, you get the same result every time. It's not true in our business. The playing field changes all the time. So you have to figure out a new solution. And the solution of the past is not the solution for the future. And that's incredibly intellectually stimulating. And so I highly recommend it to everyone. And if that sounds attractive, then I would do it.
It's great. Howard, thank you for being here.
Okay, John.
It's a pleasure.
Thank you all.
Howard Marks.
Thank you very much. That was great. Good job. Thank you, John. Thank you, Howard. Our closing keynote is sure to be an intriguing conversation, and we'll touch on a variety of topics, including finance, government, and politics in the year ahead. This keynote will be moderated by Ron Biscardi, Chief Executive Officer of Context Capital Partners. Ron will be chatting with Gary D. Cohn, who is an American business leader, philanthropist, and the former director of the United States National Economic Council. Gary served as Assistant to the President for Economic Policy and Director of the National Economic Council from January 2017 through